Ray Dalio mentions in his book being 12 years old and trading airline stocks while he was collecting money, being a caddy on the golf course. I did the exact same thing. I was trading silver, and I was collecting money by shoveling snow in Wisconsin. So I think I much prefer being a caddy in the Northeast than shoveling snow in Wisconsin, but that's the way it turned out. And all the way to the part where I'm considered the largest option seller in the country. And we were the go-to option selling company. We've now, in my mind, improved our craft. I think we've learned practically every lesson there is in this industry and in this business. And while we're not right all the time, no one is, there is risk involved in doing this as well. But we have a much safer structure now that we manage portfolios with, and it's a breath of fresh air for everyone.
Well, let me ask you about options because, Luddites and novices, as I describe myself, I steer clear of options because they scare the hell out of me. I understand the ability to not have to come, buy an asset, but buy a contract, depending on whether I think that asset is going up or down. But the volatility that can come with one wrong mistake is frightening to a lot of people. You've experienced it. So how do you calm the fears of an investor who would go into options?
Interestingly, Adam, in one of our books that we wrote, we describe approximately 3 or 4 different approaches to option trading on stocks or on commodities, which is what we specialize in. And you can vary anywhere from extremely conservative positions that are extremely well hedged, all the way up to selling what we call pure premium. In other words, naked option selling, extremely high chances for large gains, however, unlimited risk. And what we've learned is taking some of that, a small portion of that potential profit, stop selling pure premium options, take some of that profit potential and build a structure. So the structure is an option spread on leverage in commodities, and the give up, the small percentage of the give up for the possible profit potential is more than outweighed by the hedging that you do. You're vastly reducing your downside risk by having a structure on. The market can move way against you in many cases, and the structure is keeping you in place for your longer term fundamental view on that option sale. And it just slows the market down dramatically. As you know, commodities are very highly leveraged, and that's why they can be very scary. Utilizing a structure slows down the market dramatically and very much vastly reduces your downside.
So let's talk in the context of what you just said, gold. We're seeing gold at record highs right now. There are calls that gold, depending who you ask, is going to hit 5,000 next year. Some are moving their predictions up a little bit faster. Why would someone consider options with something that can be as volatile as gold?
Interestingly, what's going on in the precious metals right now is practically ideal for the type of option trading that we do. What we've noticed in gold right now, Adam, and like you just mentioned, a lot of people are upping their expectations for what gold might do this year. Never before have we seen the price of gold not deter buyers. It almost seems, Adam, that the higher it goes, the more people want to own it. Central banks around the world have made up their mind and made a decision that they don't own enough gold. It doesn't matter if it was at $3,000 recently. We're at $4,000 plus now. We're around $4,300 or $4,400 today. They don't care what the price is. And that is allowing the ideas of $5,000 gold and beyond to actually be quite realistic. Prices that people wouldn't even dreamt of not that long ago are really materializing now.
But isn't that the kind of, I'm going to use the word euphoria. If people don't care, it's the same kind of emotional, even if it's a central banker, and God knows central bankers get it wrong. isn't that the same kind of euphoria that leads to bubbles? As I mean, we're hearing Jamie Dimon and others talk about bubbles in traditional asset classes like equities.
Well, gold is a hard asset. Stocks are paper. They're companies, and there's bottom lines, and there's quarterly dividends and things like. There's only so much gold in the world, and the fact that the demand is so strong right now, it is outpacing production. Can it be a bubble? Certainly, it can. Look what happened, earlier in the century, the dot-com bubble. The thing is about that, dot-com companies didn't make any money, so of course it was going to turn into a bubble. AI is different now. AI companies are making money. They're making billions of dollars. I think a lot of people want to diversify their portfolio slightly and just owning a hard asset. Taking a small percentage of, your portfolio and owning a hard asset has started making a lot of sense to people. And of course, FOMO is taking place beyond belief right now.
Oh, absolutely. So let's talk about, what are some of the considerations, whether it's commodities or, different kinds of strategies with options that investors need to think of?
Primarily, what we've learned in 2025 is that you don't need to take the most aggressive approach when being long coffee or copper or cocoa. All of these markets this year, Adam, doubled in price. And taking a conservative approach through option structures, that's what we know best. That's what we do. Slows down the market. It gives even a small investor the ability to participate in this and have a limited downside risk. The idea that commodities have done so well this year, I think, is going to transform the institutional investor, the high net worth investor, to consider doing something like this. So many people, especially the institutional investor, they think of commodity trading as that movie from the 80s. Eddie Murphy and Dan Aykroyd trading frozen concentrated orange juice. That has changed, and 2025 has done that, with the stock market up 10 or 12% this year, and commodities that are household names like cocoa, coffee, cattle, gold, silver, they're up 100%. And the reasons why they're up 100% are still in place and could likely go quite a bit higher in 2026. And I think we're winning over a lot of investors that never thought about getting involved in commodities.
Would you be willing to venture how long you think the bull run might go on in gold and silver?
As long as we have debts in the trillions and trillions and trillions of dollars and adding another trillion or two this year, until that stops, gold and silver priced in US dollars, it could continue for 2 to 4 to 6 years still.
What about coffee? Wouldn't the price of coffee, I remember prior to the tariffs, it was about demand and there was drought. I think it was Brazil that had drought. But what about now? It seems to be tariff driven, and I do the shopping in our household, so I know coffee's gone up in price because we drink more coffee than water. And that's not a joke. We really do. It would seem to me, again, as a novice when it comes to options, that eventually this will level out. Maybe even the tariffs would come down on coffee. I guess it depends on how you play the options contract with that. But how do you determine which contract to go for?
Interestingly, there was 50% tariff put on Brazilian goods. Fortunately, while Brazil is the largest producer in the world, there is Venezuelan coffee and Colombian coffee and Mexican coffee and Guatemalan coffee that tastes, in many cases, better than the Brazilian coffee. So fortunately, while Brazil is the largest producer, I think Brazil produces about 40% of the world's Arabica coffee. We can't get it from other countries. So that has flattened out the possibility of tariffs being the only reason why coffee prices have gone up in 2025. Brazil, the largest producer, had a 100-year drought last year. And, there's a lot of hardworking people that climb those mountains and, take care of the trees, and they harvest the, coffee and roast them. It's up to Mother Nature. And we've got La Nina and El Nino to follow things like this. If it's not raining, it doesn't matter. The price goes up. And last year, Brazil had what they're calling a 100-year drought. Flowering season is in November and December, and that determines how much coffee we have next year. So all eyes are on Brazilian weather patterns right now. It looks as though it's going to start raining. It started raining recently. We could have a very large crop in Brazil right now. Coffee prices, as you mentioned, they have gone up quite a bit this year. They were at $2 a pound. Now they're at $4 a pound. How we trade and invest in commodities like coffee. People get wildly bullish on the market. They understand that it's gone up a lot. They see at Starbucks and at the grocery store it's gone up so much, and they'll buy call options in coffee, betting the market's going to go up. Right now, call options at the $10 level, which is 2.5 times the price of coffee, we think is probably a pretty good sale, and you would do that with a structure. You wouldn't just sell pure premium there. But when gold is moving like this, when cattle is moving like this, when coffee is moving like this, these options do get overpriced, to your point. And that's what we think is going on right now.
Since you're from the Midwest, I got to ask about soybeans. How would anybody approach that, given that whatever happens with soybeans and American farmers is at the whim of the U.S. government right now, not necessarily the market?
Years ago, the soybean market was Illinois, Indiana, and Iowa, and all eyes were on those 3 states. They produced approximately 80% of the U.S. soybeans. And why is that a big deal? Because soybeans turn into protein, chicken, pork, beef. You really can't do a whole lot when you're going out to eat or at home without soybeans. And of course, tofu is a specialty at many houses as well. Basically, Brazil has just become one huge farm. And they are now the largest soybean producer in the world. So soybean prices have been extremely flat. Fortunately, because cattle prices have dramatically gone up. So thank goodness that soybeans have not, because cattle prices would be even higher than they are right now. Presently, soybeans and corn are probably one of the 2 most stable commodities that we follow. And when they become extremely stable like that, premiums dwindle quite a bit. So in that instance, we would not be trading options on corn or soybeans right now. We follow about 12 commodities. And generally, of the 10 to 12 commodities we follow, there's usually what we consider strong opportunities in probably half of those at a particular time. And then we'll watch the other half for something to develop. And right now, soybeans are on the shelf right now.
What advice would you give as we start to wrap up? A young person, someone in their 20s, who wants to trade, who wants to explore options, what would you say to them?
Adam, interestingly, the vast majority of our clients are high net worth investors. In the future, these getting to learn investing in their 20s, these investors could very well be high net worth investors in the future. Learning the business, learning what moves real assets up and down, I think is a great idea. The new portfolio going forward, I don't think is going to be 60-40 stocks and bonds. I think it's going to be 60-30-10. And the 10 is going to be alternative investments and likely in commodities. The 2025 move in commodities is going to win over, in my opinion, so many new investors. And if you're in your 20s, learn about it. Learn what moves the market up and down. There's something called the Commodity Research Bureau Index, and it describes exactly anything from cobalt to coal to asphalt. You can learn anything that there is to know about these different commodities, and then learn option structures. You can do this in a year or 2. You could get extremely good at it. And then when you do have assets to invest, you don't just have to be in the stock market. I know stocks have done extremely well for the last 3 or 4 years. They had 1 or 2 down years. But when the stocks fall, they all fall. When the market tips over, all markets go down. And having some knowledge in another asset class, I think will be very valuable for people who are coming up in the ranks.